This is Business Breakdowns, powered by MicroCapClub, a series of deep dive conversations with microcap companies and the investors that know them best. Our goal is to explore the inner workings of microcap businesses while giving our community direct access to compelling companies and their leadership. I'm Ian Castle, founder of MicroCapClub. MicroCapClub is a private community of the world's best stock pickers. Since 2011, our members have profiled 1,400 companies and over 300 have turned into multi-baggers. That's at least one big winner every month for 14 years. If you enjoy finding great companies early, well before Wall Street pays attention, MicroCapClub is where you belong. I hope to see you in our community. And now a quick disclaimer. This presentation is for informational purposes only and should not be construed as a recommendation to purchase or sell any security referenced herein. Planet Microcap Holdings, LLC and MicroCapClub, LLC are not licensed brokers nor registered investment advisors. We, our partners, contractors, members, subscribers, guests, or affiliates may or may not hold positions in one or more of the securities mentioned in this presentation and may trade in such securities at any time. We recommend you consult a licensed investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this presentation.
Welcome back to Business Breakdowns. Today, I'm joined by Des O'Kell, President and Director of Enterprise Group, and Erik Voss, General Partner at Mission Vertical. In this episode, we discuss Enterprise's position in site, power, and infrastructure, the growth outlook tied to the Canadian natural gas and LNG, capital allocation, and what could drive the next phase of the company's growth. Let's get into it.
Des, before we get into the presentation, why don't you guide us through your professional background, just a brief overview so we can get to know you better.
Yeah, certainly. For the past 35 years, I've been in executive operations in resource development and services over the years. Of course, CEO and Chairman Leonard Drozik and myself, we founded Enterprise. We're entering the year 21. So of that 35 years, Enterprise has been a big part of that. We've gone through some interesting history through our Canadian energy landscape over the last couple of decades. So that pretty much makes up a good life of activity in the corporate world for sure. Okay, well, I'll take everybody through a fairly this is a little more of a brief slide deck. I would imagine some of the MicroCap Club folks have had some exposure to us. Those that haven't, I'll make sure we pick up on the basics here. We'll just move through here, of course, forward-looking statements, as everybody loves to read these. So at a glance, you can see here we're a leading provider of site power systems and infrastructure and services to the Canadian resource and construction industries. On this slide, we just in the recent week or two just released our annual year of 2025 and Q4 of that year, and in that you can see we've got a 5-year revenue CAGR going on at 18%. Generous cash flow on the 36.5 million in revenues. We've got operating cash flow at 16.7. We've got a very in our industry and comparative to peers in equipment heavy services to the energy sector. Our 32% adjusted EBITDA margin is on the high side. So we're a higher margin player in this segment. Proud to say that management and a few of the directors, we have right around 30% ownership of Enterprise. So we ask on this slide, of course, why Enterprise? And it's a cash flow driven growth story. Right now, there's a robust macro outlook for natural gas. We'll touch on this a little bit here all the way through. Natural gas is uniquely positioned to support North America's record power demand growth. And there's significant strategic interest also in Canadian natural gas plays that highlight their importance of supply. And there's bipartisan support across our country here for LNG, which implies sustained natural gas activity levels. And it's important to note that the majority of our energy clients are tier 1 natural gas and gas liquids producers. So we have very little exposure to the oil extraction here in Western Canada, and the majority of our exposure is with natural gas producers. And what we're bringing is to our clients is we're the leading site power and infrastructure supplier to this industry. So we're turnkey and industry agnostic site electrification solutions, and the majority of our clients are blue chip players. We have a competitive advantage supported by quality, reliability, cost savings, and sustainability. Our existing mobile power fleet supports up to 40 megawatts of site electrification at the moment. One of the messages that David and I talked about briefly here before on camera here is this next section here, which is a tempered CapEx to drive free cash flow. Recent growth CapEx and M&A activity have expanded our fleet and have positioned enterprise for growth. So we're looking going forward. We've spent some growth CapEx, and we've built our fleet to the point where we're well capable of higher revenues from this existing fleet than what we delivered in 2025. So our vision now and our focus will be optimizing utilization of the existing fleet and moderating our CapEx and maximizing free cash flow. So as you can see here, with 2025 behind us and generating 16.7 in operating cash flow and 12 million the year before, there's an opportunity to create some free cash flow and build on the cash line. And one of the messages there is we want to make it clear to shareholders that we're not going to be a serial diluter by always going out and raising capital. We got, prior to 2024, we substantially all of our growth CapEx was from our cash flow. So we want to be able to illustrate to the crowd that our ability to self-fund ourselves is well within our capacity. And of course, our management team, we have a proven track record, and it's aligned with leadership. We have a seasoned leadership that, as I mentioned before, ownership right around 30%. And we have an attractive track record through these cycles that we've gone through. Like I said, over the 21 years, we've seen some ups and some downs. The last downturn was a long one, from about late 2014 all the way into 2021, 22. It was a 7-year, very low activity period that we went through. Half of our peers and competitors didn't make it out the other end. We were able to navigate that. In our opinion, we don't mind patting ourselves on the back. We did a very good job of bringing the company through that low period. And every year may not have been earnings per share in those years, those down years, but we were cash flow positive, something I don't think many of our peers and competitors can say. So we've had a long history of accretive acquisitions, divestitures, insider buying, and share buybacks. In fact, the current NCIB, which is for about the buyback of 5.6 million shares, which is active, it comes up for renewal at the end of this month. We've already started the paperwork. We'll continue the NCIB into another 12-month period. And since we've been with an NCIB program, we're well over that 12 million share figure in buyback. Just a quick visual on our two main prongs, which is power solutions and our site infrastructure. We do have 5 subsidiaries, but I really do want the audience to understand that we really look at the even though there's 5 subsidiaries, there's 2 segments here: power and site infrastructure. You can see here our 2 subsidiaries that are handling the power project side, which is EPP, which this is the more short-term temporary project power systems and associated equipment along with that. And the power solutions division is more of the longer term, 12 to 36 month installations and permanent installations of our turbine technology, which we'll talk a little bit more of. The 3 other subsidiaries specialize in a all-encompassing site infrastructure packaging for our clients. So why we win? Well, it's quality, efficiency, and sustainability. We have this leadership position solidified as the exclusive provider of Flex Energy Solutions gas turbines in Canada. Over a couple of agreements, and then eventually an acquisition of Flex, their Canadian business, which we're almost coming up to a 1-year anniversary of the transaction where we acquired the Canadian business. But what that gave us was the exclusive OEM representation in Canada for all industries, all types of application of the Flex turbine. We'll go into, for those of you that are new with us, we'll talk a little bit shortly about the Flex turbine and its superiority, especially in the Canadian extreme temperatures. But in the first case here, industry-leading quality and reliability, these turbine units have up to a 20-year operating life. Uptime is over 99%. Because there's only one maintenance interval annually, and it's about a 5 to 8 hour maintenance interval annually. So the uptime is incredible with these particular turbines. Also, it's a very advanced fleet. All of our fleet, no matter where it's located, we have connectivity for remote monitoring of our units. So our turbine technicians and what have you are capable of monitoring the units. If anything's going a little bit crooked or what have you, we'll know about it before the site would know about it, and we can properly get people, technician out to site and deal with things in an efficient manner. And of course, significant operating efficiency is savings. This is specific to fuel use. In most cases, we are displacing diesel. Diesel is costly. It has emissions issues, obviously, but because we're offering many of these solutions to the energy sector, and many of the energy producers produce their own natural gas on site or nearby the projects, there's an opportunity to use the client's own fuel to generate the power in our unit. So when they a typical site may use 2,000 to 7,000 liters of diesel fuel a day. Well, at $1, well, now I mean diesel is now over $2 Canadian with the recent activities going on worldwide. So normalized, that'd be about $1.60, $1.65. So those are real fuel bills that the producer is paying for these project sites. If we can bring our nat gas turbine units to their site and hook up to their produced fuel in the remote areas, then they're absolutely eliminating the cost of fuel delivery from a third party supplier to bring to these remote areas. So it's a massive cost savings. But let's say the client does not have access to fuel, or we're looking at the mining industry or what have you. Compressed natural gas is actually a 60% savings to diesel. So you can see in this number 2 section in the middle of the screen here, 100% cost savings when we displace diesel using the client's fuel, or 60% when we bring in compressed natural gas. On the emission side, you can see on number 3 on this slide, when we move from a traditional diesel burning unit, you can see a 350 kilowatt diesel unit compared to our 333 kilowatt gas turbine. You can see here particulate matter 2.5 and 10, SOx, NOx, volatile organic compounds, and carbon monoxide. When you move to natural gas in our turbine, you're not talking 20 and 30 and 40% reductions in emissions. They're anywhere from 88 to 100%. Obviously, SOx, you don't have any SOx emissions with natural gas here through our turbine. So these are very valuable, especially to our tier 1 clients who are bound here in Canada by getting their emissions lowered through their development cycle. This is a bit of a simplified frac site example of where our site infrastructure, and this is a good time to talk about, well, what is site infrastructure? There's 3 prongs to site infrastructure. These are very remote sites, so we're nowhere near overhead power. So you need to bring in mobile power. That's where our reliability and the superiority of our natural gas turbines, the flex units, you can see they're placed on site. Now, how do we get the power around to the site so everything can plug in? Well, you can see there's cabling and distribution panels. We call that the microgrid. It's around the exterior of the site. All those mobile structures that we also have a large fleet of those. Those are the offices and command centers and medic buildings and so forth. Usually on these sites, there's 5 to 15 of those structures on site. So that's another element. So there's power is prong one, the mobile structures is prong two, and of course, these sites need to be lit up 24/7. So light towers, stadium-style light towers are around the outside, illuminating the site. So that's, and then there's, various other accessories in this, what we call site infrastructure that we bring to site. But those are the three prongs on these mobile temporary power sites. This isn't a complete list of our clients, but many of these names will be recognizable. Some of them are multinational, but these are who we're working for every day in the field. And of course, there's diversification opportunities for us that, we're also supplying other off-grid sites, construction and so forth. We're starting to penetrate into the mining industry. We're in front of two mining builds in Western Canada, one in northeastern BC, one in the Yukon. So we're penetrating what you saw there on this previous frac site. This type of a setup is hand to glove fit also in mine building. So there's opportunities that we're in front of us in there as well. Construction, of course, there's an array of data centers. Obviously, AI is a very, very big talking point these days. But the data centers, because our power platform is a smaller platform, when you're talking some of these gigantic AI data centers that are being built, these are in the 100+ megawatts at a time, sometimes 1, 2, 3, 4, 5 gigawatts. That isn't our power platform. But there's the smaller inference style opportunities in AI where it's a smaller setup. You don't need to be on fiber. Those are the opportunities that we're looking at the moment. And of course, temporary and emergency power response, industrial backups, and of course, combined heat and power, which is the flex turbine that we have built our fleet around. It was developed by a Fortune 500 company called Ingersoll Rand, and then eventually spun out. And the management bought the spin out and named it Flex. And it was designed for commercial, industrial, combined heat and power applications, which we can talk about here quickly. This is an installation here in Canada. And you can see there's 2 flex turbines here on the back of a municipal. There's a small city in Alberta, and this is their new rec center. So there's 4 ice skating rinks and 3 pools and a running track and gyms. It's a big, large building. This has 2 of our 333 kilowatt turbines in primary power application. So it's hooked up to the utility grid, but primary power is here being delivered by the flex units. And not only that, the unit was developed to use combined heat and power. So a unit of gas goes into the unit. We get electricity out the other side, but the heat that the unit is creating, we're able to loop that into the building, into the boilers. It's heating the pools, it's heating the air or the HVAC, even heating and cooling. So these are capable of allowing you to have fully primary power and full, HVAC supply of heat and power. So it's an interesting opportunity because there's many businesses and manufacturing facilities that cannot afford interruptions in the grid. And of course, here in North America, we have a grid, an electricity grid that is going down in quality. The maintenance CapEx into this grid has been non-existent for 45 years. So we have a grid going down in quality. And at the time, we've got industry, commercial, and societal pressures demanding more power. So as we go, and that's before we talk about AI massive power requirements. As we go through time, we're going to see more and more interruptions. Well, the businesses that cannot afford to be disrupted frequently, this is an opportunity to self-power, self-heat and cool their particular facilities. And that's something that has been lightly pursued here in Canada with the Flex unit. We're going to change that. That's a big part of our future verticals. I wanted to show you that just in this project, which is coming up to year 5 of the install, these units have been running 24/7 for the last 5 years outside of the short maintenance interval. And over the course of the these are the website that this municipality has all these figures counting up. And of course, the total project cost was a couple and a half $1 million. Annual savings 335,000 per year, and you can see the type of emissions reductions and annual electrical energy savings that this particular configuration is giving them. This is a slide talking a little more about the LNG opportunity. In Canada here, almost coming up to a year in June would be our very first cargoes of our very first LNG project, which is LNG Canada, headlined by Shell and a few other partners. And it is a series of 4 other intervals of new LNG projects. We've got the wood fiber, which just recently made an announcement they're about 60% constructed. So we're going to see them coming on maybe later in 2027, as well as Casilla Sims and Cedar. So at maximum, when LNG Canada brings in phase 2 and then these other 3 projects, we're going to see these LNG projects taking away over 25% of Canada's natural gas production to other markets, mostly the Asian markets, which is a growing market. So this really underpins, like I said earlier, our natural gas clients that we're supplying this equipment and service to. We see about a 10 to 15 year development build out, which is a very, very bullish opportunity for our positioning. This is the last slide. This is a bit of a financial snapshot of today. Closing price at $1.08 gives us a fully diluted market cap of just under 94 million. EV is around 107, and our cash position is forward of 11 million. Sorry. One thing I want to draw your eyes to is the total adjusted net equity, and what this is because of our debt facility, we have our fleet appraised twice a year, one full appraisal, and then 6 months later a desktop version. So we're intimately aware of our disposal value of our fleet, and that is a different number than how we account for our depreciation of our fleet on our balance sheet. So that 121 million is a net equity position in the actual physical appraisals of our equipment, which when you look at it per share, we're worth about $1.40 if you actually dismantled us and sent us to the auction. So you can see at $1.08 here today, there's a tremendous amount of value that we're not yet getting credit for going forward.
Before we get back to the program, I have an invitation for you. I'm Bobby Kraft, and I want you to experience our in-person live events. We bring many of the companies and guests you hear on this program directly to you in Las Vegas and Toronto. It's where the microcap community connects and great ideas are found. Don't just listen to the conversation, be a part of it. Secure your seat today. Head over to planetmicrocap.com right now to register. See you there.
That's brilliant. Thanks, guys. Des, thanks for coming on the platform to give us an update. You just ended with talking about natural gas production outlook in Canada. I know that we're effectively 9 months into Canada being able to finally access the global markets. And I wanted to get your sense of how confident are you that the industry will have long-term growth. You mentioned the 4 projects, but are there any gain factors that wouldn't allow those things to go forward?
Well, at this point, I'll talk about LNG Canada first because that is the one that is in production. It's phase one of their planned build, and phase one includes train one and train two. Now, train one came on and they got it up to capacity, and then they brought train two on in December, and it has achieved full capacity. So both those trains are operating at about 1.8 BCF a day in throughput. Um, phase two of their build is basically another two more trains, and they are going through their final investment decision on building phase two is supposed to come in the next few months. There is overwhelming consensus that they are going to go ahead and approve that investment decision to build train two. So that'll be 1.8 plus another 1.8. So that's how far along and how certainly sure the industry is, because they're very confident that phase two is going to be decided on positively. Now, wood fiber, they're over 55-60% built, so there's no past the point of rescue on that one. I think it's going to get built. Cedar is a First Nations led LNG project. It's under construction now. The fourth one that has yet to get construction or start construction is Casilla Sims, another First Nations led group. They were funded by the federal government. I think they contributed about $350 million. And not only that, the new Canadian Prime Minister, with his new C5, Bill C5 office of, he's put an office together to fast track certain projects that are in the national interest of the country. And that Casilla Sims was on that particular list back in January. So
Okay.
everybody is fairly confident that these four projects will be built to capacity and nameplate. And that alone is, Canada right now is producing about 18-19 BCF of gas a day. Come 2030, 32, we, add a few more BCF of growth to that. When you look at those capacities, it'll be about minimum 25% of that being taken away to new markets that Canada has never serviced before.
Brilliant.
So we're confident.
Okay.
Eric.
Can we talk a little bit about business development? You laid out a very compelling case why someone would want to convert to natural gas for a number of different reasons. I know you've hired a VP of business development in 24, Michael Lawson.
Yeah.
We've talked about timing of kind of getting new business going. Can you help us with the length of the sales process, maybe obstacles, and where you're seeing traction right now, Des?
Mm-hmm. Well, there's no doubt because our methods are there's some complexity to it. There's some technical, it's some advanced technical implications to adopt these methods. There's some education, technical education, and so forth. And not only that, by examining if the producing client has their own natural gas available, and of course that's the tremendous cost savings that's in play. But on first meeting, if in the business development pipeline, if getting that meeting is obviously achieving that is number one. Sitting down and having whoever you're sitting down with understand the features and the benefits and the efficiencies and what have you. Once you get past that, there's no one or two decision makers that are involved here, because there's logistics of on-site fuel being made available, because these are projects that are really wherever you can displace diesel. These you should be looking at these projects. Well, if we're looking at a tier one producer, they have a drilling department. they have a completions department and experts with flowback and what have you. And all of that needs to, all those gatekeepers and decision makers really need to be, available to understand the technical presentation that needs to be understood for an overall, yes, let's get you on a first project, let's see it and what have you. So for example, we brought on a client that we announced back in August. That project started early August. Our initial first meeting was the year before in December. So it took, 8, 9 months from first meeting to the project awarding. Now you know, adoption in that sales pipeline is sometimes it can be shorter, sometimes it can be that long, but there's no doubt about it. There is an education, a technical presentation, and the education that has to be understood by the client. So sometimes it can take a little bit of time.
And are
Um,
you seeing traction now that you're a year and a half into kind of this business development effort?
yeah, actually, at the moment we're getting a nice surge in activity. That sales funnel we've got it built up, and it just so happens we're getting we're experiencing a convergence of results from those business development offerings or efforts, sorry, that we've been building, and we're getting a lot of activity at the moment. It's interesting because we're entering Q2, which is here in Canada the spring breakup quarter, but we're kicking off a good deal of projects and with some new names. Existing names are expanding uh, their their uh, uh, their implementation of our methods to more and more projects, drilling and completions and fracking, plant sites. These out in the areas that the companies are producing. Um, they have these gas plants out there, and they're called gathering system gas plants. So you've got all the well pads all over the place, and you need to have a central hub where all of the pipelines coming from the wells themselves come into a gathering system, and then it goes out in a larger pipeline to the more midstream and what have you. So these plant sites quite often are well away from overhead power, and these flex turbines are absolutely in their dream spot, being in these because they can operate on the produced gas, provide the whole site electricity, whether it's the infrastructure that the people work in and what have you, lighting. But that's a more fixed location than our project style, right?
Okay.
So
Okay.
yeah, it's converging on us, and I really see that we're going to have like we saw back in 2024. I think we're going to get a revenue surge here uh, inside of this year. That'll I can't wait for us to just roll out our queues, and
Awesome.
it'll evidence itself.
Let's talk about, because 24 was quite a good year. Let's talk about last year, because it looked to me like your underlying business was okay, but I've read that you had an issue with one of your top three customers. Can you kind of help us with what happened there?
Yeah, very good client of ours for some years. We got a communication as well as other service, and there's a list of drilling and we were all on this email basically saying come mid 2024 that they were going to take a break to the end of the year. Did no real disclosure of anything. They just said we're going to take a break. We've been hard at it, and they gave a tremendous amount of activity in the Q1, which was a big quarter for us, and it ran into Q2 in 2024. And then they said they were going to relax, but they were going to come back in the new year of January 25 and go again with back to normalized levels of activity. Well, January of 2025 came, and really we were on one. They had one project in the throughout the whole year of 2025, and the guys on the ground that we have a relationship, and I don't know if they just didn't have the information, but they were telling us that, next quarter we're going to get started. It didn't really come. But then later in Q4, we saw a news release that came out from that producer, and they had finalized a transaction selling 20% of their Canadian production and 20% of their holdings in LNG Canada to a global LNG investment firm. And now it all made sense to us. They
Okay.
were in a due diligence period, and quite often we see this in the energy sector. When you get caught up in a transaction, they slow a bunch of the spending down. They kind of stop, get a snapshot of the due diligence and what's happening, and then the transaction happens, and then they get back going again. So
And so
that's
you couldn't redeploy the assets because you thought they were coming back, I guess.
well, we're at the same time we were saving their a few of their packages for them, because their guys were letting us know that they were going to get back going again. It just it took 5 quarters.
If that
Almost
was a
6 quarters.
consistent customer through 25, what kind of revenue levels are you talking about? What would revenue have been last year if they would have been consistent?
Okay. Well, I think revenues were 36, 3 or 5, so 36 and a half, somewhere in there. We would have come in 41, 42 with revenues if they
Okay.
had have been, still rolling along at normalized activity levels.
Okay. So what you're saying is that's starting to ramp back up and maybe back to previous levels. Is that fair?
Yeah, they're back to a pretty good level of activity. I mean, we're in month 3. I've been monitoring what we've been doing with them. It's at a good pace. But what it did, and in 2024, we also had a little bit of weakness in certain regions, because we had some terrible forest fires happening in our world, and that had some effect on things. There was a number of things in that middle of 2024 that happened. This was one of them. But what it did, if you look at 2024, we had consolidated revenues, I think 34.5 million. Then we come out this year with 36.5 million. But without that client, what's being masked is we've had a lot of successes bringing on new business, new names, expanding with other clients. All it did was make back in a little bit, what we lost with that one client.
Mhm.
So it looks from the outside that we had a pretty growth-wise, a pretty anemic 2025, where in fact, with the absence of the one client, we actually, made that back with some of the new names, the new activities
Yeah,
that
that's really
we've
good color.
opened up.
That's really good
Yeah.
color, Des. I want to ask because you got this Flex acquisition that's, as you say, it's almost a year in, and I know you've added and spent a year investing in turbines. When you acquire a turbine, can you help us with the IRR or expected payback, or how should we think about utilization, pricing, whatever you can help us with would be helpful.
Well, Eric, we don't on purpose. We don't segment our financials. That's kind of on purpose. It's a competitive issue for us, as well as getting granular on one asset class of ours, namely the turbines. Um, you know, Getting granular on that, it's hard to, or we're reluctant to disclose kind of where pricing and returns are on a singular asset class.
Okay.
And the reason why is the flex turbine is very well known in our energy sector. In fact, many of the clients that we're working on their temporary projects with, they have bought and own them in their gas plants. So they know the cost of these units, and if we start to, I mean, in the equipment based services business, we have some of the highest margins. In fact, we have the highest margins out of everybody that reports as a public traded company. Our margins are the highest. So
Okay.
I can assure you that it's a lucrative part of the business. Out of all of our asset class, the turbines are one of the more lucrative. The microgrid components are very margin rich as well. So we have a little bit of a reluctance to talk granular about it. All I can say is our consolidated numbers speak for themselves. They're
Yeah.
good margins.
Okay. I have one more question before we open it up, and I can follow up if we don't have any questions. But
Mhm.
so for the last 3 years, you've spent about 16 or so million dollars, and I think certainly this has been an opportunity for you to grab share and convert diesel generators. I'm compelled to ask a two-part question. One is, what is your maintenance capex? And second, I see you caught a downgrade last week, and it looks like it was predicated on his DCF and his view that capex is going over 17, but then also in the next 2 years jumping to the mid 20s. So you started off saying you're going to start moderating that, but how should we think about capex spending this year and going forward? And is this guy right that you're going to spend over $70 million over the next three years?
Yeah, well, first of all, maintenance capex. At the moment with the size of our fleet, it's about 3 million a year.
3 million.
Okay, just to get that out of the way. Um, I saw there's the three analysts. I know the two you're talking about, because the one from Acumen actually doesn't have any figures on our forward-looking capex, and the two that do, they're wildly different. Uh, I believe these analysts have modeled their own estimates in these reports. We
Okay.
haven't commented on them about future capex, as we haven't contemplated our estimates for these years going forward. And I think we've discussed this points before on different uh, interviews, and I know with a previous interview with David. In our industry, the energy services industry, our visibility past 6 months just doesn't exist. So it's very, very tough for us to have any analyst ask us, what are your thoughts and what are your guidelines on a 2027 capex,
Okay.
let
But
alone
just to
2000. I
reiterate, for
mean,
this year, you're going to moderate, and
yeah,
you're thinking about free cash flow through the year.
yeah. I mean, and I'll get a little uh, detailed on that. We do have a fleet that is capable of much more. We think 55 to 60 million dollars in revenue, done properly and leaned on. So we have some focus here to uh, capex this year will only be special situation to customer demand, plus the 3 million maintenance. We always have to continue that. Um, and drive the free cash flow onto the cash line. We want to give the investment community a message that we're not going to be serial diluters of always coming to the market raising capital, but under only special situations will we consider capex. We're going to stay, and the reason why we have some headroom for expansion here that's already in the fleet.
Okay.
So this is the year to match it up with utilization, optimize that. Um, when there's demand, we will acquire. I mean, we're already into month 3. I've bought 3 turbines here just in the last 2.5 months. There's more that are coming off the assembly line that we've already committed to. So we are going to have some capex this year, for sure. But what I'm saying is the sort of 15, 17 million that we've been kind of doing the last 3 years is going to be much more moderated,
And
and
do you have a
that'll
goal for
drive
free
the cash.
cash flow? Like, do you have a goal for what you want free cash flow to be, or what you want to show, just to demonstrate that you do?
I know it's a stretch number, but internally, we think we could most likely get $1 million a month. So call it, 9 to 12 million is kind of in our range, on top of the 11 we already have in the cash line at the moment. So I think if we can get to the end of the year and show, you know, plus or minus somewhere around 20 million in the till, on the backdrop of our debt profile and our asset line, I think is a very right side up balance sheet. We're proud of it. but we do want to fortify that cash line.
Okay, that's great. Yeah, I'm gonna hand it back to David and lob one last question at you. You mentioned the NCIB outstanding, and you're renewing that. Can you talk as we kind of look at the list of questions? How are you thinking about buybacks right now, Des?
Well, right now I'm pretty aggressive. These prices, we don't agree with them. I mean, I know sometime last year we got up to almost 270 Canadian. We might have got a little ahead of ourselves up at that level, but just like this has gone down too far. We're active every day. I run the NCIB account. I'm on the bid every day, but we have certain rules. Like I can't go buy the stock off the offer. So I got to sit in the bid structure and kind of wait for it. And I do. And when we have somebody that wants to let go of a bunch of stock and he hits into the bids, I've usually got 3 or 4 bids there taking it. Okay.
Okay.
So whenever I can, I'm being aggressive, but only within those trading rules that's within the NCIB, right?
I understand.
So bought some today, Friday. I think we bought 50,000 Friday, 55,000. So we're there, and if we can buy more, we will at these prices.
Okay, good. Thanks, David. Any questions out there?
Yeah, we have a bunch, and I think they will keep coming. I just think your questions are great, Eric. So thanks for that. The first one we got is you hired a dedicated sales director last year, and I guess we already touched a bit on this. The idea was to explore introducing flex turbines in other industries, such as mining, given the Middle East crisis, which will be boosted to the Canadian. Which will be a boost to the Canadian LNG sector. Has this altered your objectives? Is it better to focus almost exclusively on LNG sector? If not, can you comment on the progress of the new sales initiative?
Right. Well, the new sales initiative, it's intact. We have activity happening with that development team. Whoever asked the question is very correct. We have a 21-year we have a reputable 21 years in the energy sector. So we are not going to let anything over distract us. We think we're maybe only 18% of addressable market in our energy sector. So we have tremendous amount of freeway in front of us to make up. So we have a very, very focused energy sector business development crew, and we'll never let focus down on that. We do have an existing. So when we bought the Flex Canada operation, the business development guy that was with that, he was with the company for 10 years that they were in Canada. So right from the start, so he's an absolute key guy on the capabilities of the unit, especially in fixed long-term installations. So he's heading up because when Flex USA owned that Canadian division, they were guided to pay attention only to the energy sector. Okay, so they didn't let him explore any of those other verticals here in Canada. That's why I said in the presentation, the CHP opportunities for the Flex unit in Canada have been lightly pursued. The only installation in Canada is the one I showed you, which is that rec center in the municipality of a city here in Alberta. So there's much more available in the blue sky opportunities to enterprise is the rest of Canada, and in all industries, temporary to permanent installation. So that makes up, and that's why the acquisition of the Canadian Flex operation is transformational for us, is because of the opportunities it gives us, and it's absolute blue sky for us. And more to come. Like I said, like I said earlier about presenting the technology and what have you. It's you need somebody that's competent to technically present product and solutions like this. So those type of people, I use a comment. They're not hanging off of every tree. So we're looking to build more of those technical salespeople. Maybe PN folks that are in the sales world, and there's a bunch of them, but they're not available all the time. But those are the type of people we're looking for to build that team. We just ran into a terrific candidate here in the last week, so we'll be looking at adding him. Obviously, we've got to go through a little process to learn a bit more about him, but that's a new candidate for the team for sure.
That's great. And are you raising turbine pricing in FY26 given the diesel is up 40% and LNG at a premium post Hormuz?
Well, we're very aware of the windows that we have available to us for price increases. But I must say our immediate focus is the addressable market and achieving a higher penetration of that market. Our pricing provides very good margins, so I'm not worried about our pricing. I don't feel it's right to rush ahead while we're trying to build that addressable market, which we're at the very thin edge of the wedge at the moment. So our focus is to get more market share, get our clients relying on the performance, the cost savings. When you build it into your client that there's to make a move will cost them more money, we want to make sure that that is fully intact, and then we feel we'll have a friction-free opportunity to raise prices. We'd like to carry on the path that we're on, get a higher penetration of the market, and then we'll start having a look at moving prices. But don't forget, the prices that we have our gear on it right now. These are good margins, and they will get better in the future.
Yeah, that makes sense. And conversely, are you willing to give up a bit of marginality for more revenue growth?
I don't think. I think we're in a sweet spot. The pricing, and I don't think it would be I don't think it would get us any more sales to reduce pricing. And I think we're in a sweet spot, and building client penetration is focus right now.
Perfect. If not in the data center space, which space is enterprise targeting to attenuate customer concentration?
Right. Well, obviously, as soon as we start moving away, or not moving away, adding clients from different industries, that is obviously going to help. There's the mining sector. There is the away from grid construction. There's plenty of construction happening where temporary and power, diesel power is used. There's displacement of diesel opportunities there. There's temporary emergency power. As soon as we start doing that, we move away from concentration, because we do have it's in our filings. We do have three clients that are Canada's some of the biggest producers in Canada. They have lots of projects, and you're no doubt going to get some type of concentration in there. Every time we start moving into any of these adjacent industries, it's gonna benefit concentration.
Perfect. And what led to lower equipment utilization in 2025 versus 2024? You had more equipment than the year before, yet revenue and earnings barely moved. What drove that? How does that trend carry into 2026? What's your strategy to improve utilization? I guess you addressed this earlier.
Yeah, I answered that question. I'd just be repeating myself.
Okay. Yep.
Yeah.
So I'll move to the next one. How do returns on the new flex energy turbines compare with the legacy fleet? What utilization rate do you need to hit target margins?
Let me see how to answer that question.
Let me refine the question, Des.
Mhm.
As you think about long-term contracts versus short-term contracts, and you're buying these turbines, do you have a preference for the long term and short term? Are there differences in margins there? Just can you kind of explore that with us?
Yeah. I mean, the units that go out on longer term, installations, 12 to 36 months, and sometimes longer than that, uh, those are good margins. Um, but when we put out mobile power turbines in the temporary project to project style, there's all sorts of other ancillary equipment that goes with it. Not only are the shorter term prices, the daily billing, higher than the longer term monthly contract or yearly, 12, 24-month contracts, uh, it's going out with a microgrid, which is cabling, paneling that we build in house. That goes out at very, very high margin. So when you have a turbine or two going out with a microgrid, and it goes out also with a package of lighting and possibly office buildings and what have you, then it really doesn't compare the two, because a unit will go out at 25 or 30,000 a month, and then but a package will go out at 3,500 to 5,000 a day.
Wow.
So,
Okay.
there's quite a big difference between the two. So if you put a gun to my head and said, you have 10 turbines, and you want to put the majority out of it, I'd want to put them out on well utilized short-term projects because of that.
And can you give us the mix of that? Is it 25/75 right now? Is it like what, like, I know your fleet is, the number in your fleet is probably, I don't know, 40s, something like that. Can you just give us some numbers there?
I'd say it's 70/30, I guess,
70/30.
between long
Okay.
term and short term. 70 being short term.
Short term. Yeah. Okay.
Yeah.
Excellent.
Well, it's a good mix considering the difference, right? Um, that I described, going out with package gear and daily billing and so forth. So it's a nice mix. We're comfortable with that. What also benefits is when you have a number of your fleet out that are booked to go out for a 24-month contract or a 36. There's pros and cons. Some of the pros is that it's out, it's making good margin. Uh, they're so reliable. A turbine tech might not even go out there in the first year to deal with anything. So, it's a very, very maintenance free with respect to, if you think about, natural gas or diesel piston engines that go out. I mean, the amount of maintenance and back and
Yeah.
forth that you'd have to send somebody to the field is just a completely different maintenance profile and cost profile for your staff to maintain those units. So, I hope that draws
Yeah. That was
draws
helpful.
that up. Okay.
That was good.
For sure. And we have another question on the buyback. Why not launch a repurchase tender for a large quantity of stock rather than the NCIB, which is optimal if high volume buybacks are the goal?
Well, we could do that. I mean, that is available to us. I believe these yearly buybacks, with the calculation, I think it's 5 to 6 million shares. That's on 86 million shares fully diluted. That's a good chunk. I mean, you know, we have discussed it between the executive of. Uh, you got to ask yourself, how many people are going to, if we were to put that news release out and that filing, how many takers are we going to get to fill us at $1.10? Really, I'm not convinced. There's 5 million shares that are going to say, okay, I'm out, and away we go and fill. I'm not sure. I'm not sure. It's up for discussion, but there's a lot of variables in that and a lot of unknowns. But it is a good question.
Awesome. And I do think this question is quite interesting. You acquired turbines in the Flex deal that were already under contract, right? Probably at lower rates than you usually charge. how do we think about these legacy contracts expiring and then uplift to the margin thereafter?
Yeah, the ones that have come due since the acquisition, we have moved prices, and we haven't had anybody decline and send the gear back yet. It's only been a few. If you remember the news release with the business, we there were 17, a fleet of 17 that were in long-term contracts or contracts. I think we've seen 7 come for renewal, and they've all taken the increase and renewed.
Perfect. I wasn't clear as to your response to Eric's question on CapEx. Specifically, are you saying roughly 10 million of CapEx spending this year and not the 20 million assumed range that may have prompted the Raymond James downgrade? That needs to be clarified because it's a meaningful difference.
Mhm. Well, I think I first of all, I said we were going to normalize, and this year we would only commit to special situation customer demand. So far, we're into month 3. I've acquired 3 turbines, used ones that from the manufacturer that came out of their fleet. Um, we've got 4 booked from the manufacturer that we may have to increase because of customer demand. But we have not put an estimate out there other than, we haven't come out and said, okay, we're going to spend 14 or 17 million dollars this year. We are going to only spend on customer demand issues, and that should moderate our number. So if he's asking for a number, I don't know it until we get through the end of the year and we can tally up what customer extra demand was. But we're going to keep it to that.
And as a follow-up, what does special situation customer demand mean on CapEx issue? Does it mean 100% utilization on the existing fleet?
Yes, I mean, if we were, at a very high utilization with a little buffer in there, and a client came to us and his projects for the next, program that he wanted to say, it's going to be for the remainder of the year or 12-month program, and we realized that we're going to have to add, let's say, half a dozen turbines and all of the associated microgrid components and what have you. That would be what we call a substantiated order from a quality client, and we would make the CapEx. So the CapEx goes along with essentially the reliability of that order
Makes
of
sense.
the utilization.
Let me ask it a slightly different way then, because you had cash flow from ops of, say, let's call it 16 million last year, and you had CapEx 16.5 million, or maybe it was 15 million of cash flow. I'm drawing a blank, but to get a free cash flow positive of 9 to 12 million suggests cash flow increases. There's your operating cash flow, 16.5. But let's say it goes to 20 million or 19 million this year, 19 and a half. And I don't have my model open, but CapEx, that would suggest a 10 to $11 million CapEx to get that free cash flow. Like, in your head, you're moderating CapEx meaningfully right now, and you don't know how much this special situation is going to be, but it's moderating. Is that fair?
Mm. Yeah, it is. It also, like I said, there's other classes of equipment that go out in packages too that we have to be mindful of. And I did say that, we completed that year at 36.5 million in revenue, but the fleet, upon proper assessment, is capable of much more than that. So what we're trying to do is we're trying to influence the utilization on parts of the fleet that weren't as well. We know that if a client wants to give us a program and we realize that, okay, we're going to be overutilized on the fleet, we're going to need to bring in another 6 more, let's say. But what other or other items that maybe we have parts of the lighting. I mean, we were fairly aggressive the last 2 years on the lighting side, so we've really increased our lighting inventory. Again, we find ourselves near full utilization on that. So what I'm getting at is, our fleet isn't just power units.
Yeah, no,
There's
no,
other classes.
we,
Yeah,
we get that, but there's this trade-off, particularly with your stock trading at, let's call it 5.5 times or 4.5 times next year's number. We all think that maybe that could be too low, considering the mix of business that you have and your margins. And there's a signal to be made if you say, I can generate free cash flow. But if we get to the end of the year and you kind of think 9 million or 10 million or whatever the free cash flow number is, and you say, yeah, you know what, we were free cash flow negative because we had all these opportunities. There's a trade-off for,
yeah. I see where you're getting
investors
at. Yeah.
and signaling. You know what I mean?
Yeah. I mean, at the moment, not knowing, what could come our way from these clients, I could give you a bit of a gut feeling that the commitments we've already made to the units we've bought and we've committed to coming off the line, we're going to need those units. If it stops there, then that CapEx figure for this year is going to be under 11.
Okay.
Maybe under 10.
That's a helpful, and the fact that management would like to have free cash flow to kind of signal, hey, we don't need to go to the markets again.
Yeah.
Yeah.
We're pretty decided on that messaging, and
Brilliant.
we're guided on that. So we're going to be pretty stingy this year.
Great. And I think we have a great question to wrap up. What's the biggest bottleneck right now for Enterprise Group? What's stopping you from growing even faster? And what are the top things that you would say need to happen for Enterprise Group to be a success story over the next 5 to 10 years?
Well, I think the success is going to be the opportunity to fill the opportunities of the power solutions, specifically with the Flex unit, its capabilities. I mean, what we're using the Flex unit for in the energy sector is half of its capabilities. We're just putting gas into it and harvesting the electricity. Putting that same unit of gas into the unit, getting the electricity, and being able to do something, with the combined heat and power, really rings out. Which gets me back to a little bit, that rec center with the 2 units and utilizing it for combined heat and power. Let me describe that a little better so people can properly understand. When you have an electricity utility, their electricity plant that might be operating on natural gas or what have you, and they're turning turbines. Let's say it's a natural gas, like in Alberta, 95% of our power makeup is in utility grade gas turbines, multi-megawatt units, 75, 150 megawatt turbines times many. Now, they're feeding it natural gas, it's creating electricity, and it's creating a tremendous amount of heat. Well, that utility is utilizing that heat and selling the electricity. Where this location that you see on the screen here, we're bringing the power generator to the building. So the utility gas that comes into that building, that's what's feeding these 2 units. But we get to create the heat here, not the utility creating heat over there, and they get the value of that heat. We get to put the gas in here, harvest the electricity for the use of the building, and we get to utilize the heat that the energy is creating. So that's where you get the cost savings, because we're taking a pipeline gas, infrastructure gas in this municipality to power these, but the heat, we're not using any natural gas for providing for the furnaces or the boilers or what have you. We're creating that here in this singular unit. So as you can see here, there's electrical energy savings, and of course there's the payback is in the cost savings, is because they don't need to create their own heat from the gas. We're getting all of the efficiency happening of heat and power coming from the Flex unit. So it's instead of sourcing to the utility power plant, we're putting the power plant here, and we get to utilize power and the heat that comes from that energy source. It's a pretty unique situation. Like I said, the original developers of this technology, Ingersoll Rand, their focus was a commercial and industrial application where combined heat and power can be used on the same unit of gas. I hope
Yeah,
that
makes
gave you an
total
answer.
sense. And I think we all got the message that this is a pretty superior kind of solution. Just from the numbers you shared, even not being an industry insider, it's kind of easy to grasp that. And maybe really just to wrap up, if we can talk in one last question, how do we think
Mhm.
about the competitive landscape? Wolverine was a big competitor before it went bankrupt. Is it all mom and pop shops? Is there a roll-up opportunity? How is enterprise thinking about this?
Yeah. Interestingly, they mentioned Wolverine. Actually, none of their they had one subsidiary that crossed over a little bit with us, and they only operated in a small region of Alberta. So we didn't. I wouldn't call that a uh, any kind of a meaningful competitor. But um, as for the landscape, any of our site infrastructure competitors, none of them have retooled their power fleet to compete with us. Well, not yet, right? But what we've done is by taking the most valuable unit, which is the flex unit, which is I've said it before, it actually operates better the colder the temperatures are. So it is the extreme temperatures that we have in our Canadian North. It is an absolute champion in those. Last year, we had 3 nights in a particular region that were achieving 52 degrees C for 3 nights in a row. Everything breaks down except the flex units. Now, OEM, they say their rating is absolutely reliable down to -40, but we've seen temperatures well past that, and everything was reliable through those temperatures. So I don't know what because in the microturbine world, there's only a handful of players. There's Flex, there's Capstone, and there's one out of Scandinavia that it's a big unit. We've seen it. It won't be a candidate for what we do in Canada. But the Capstones, we own 6. We've seen their reliability and their performance. We're not buying any more. We've seen enough of them. It's not something I would build a fleet around. But that's it when it comes to now. Microturbines are basically turbines that are under a half a megawatt, and in that class, there's only 3 of them, 3 manufacturers.
If you enjoyed this conversation, I'm sure you'll love microcapclub.com and subscribe if you'd like to follow along. Thank you so much for listening.